Shana, I first want to get your thoughts on what we heard from Fed Chair Powell. We, of course, were anxiously awaiting what he had to say. Did we learn anything new? What were the key takeaways?
The key takeaways, in my opinion, were that he supported many of the comments that other Fed members have made in the last month or so. Many have come out and reminded us that they are going to be very serious about keeping inflation under concern. Lots of reflecting on 70s and 80s policy mistakes that were made, where there was a lot of volatility in Fed action, and they were never really able to get inflation under control as a result. So he reiterated multiple times that their policy is to make sure that they address inflation and that the trend is stable and downward trending, in order to ensure that the market has been really thinking that the Fed and Chairman Powell would pause if there was any weakness in the economy. And he sort of addressed that by saying that that would not be the case, that they would stay hawkish to make sure that they addressed the main concern that they have, which is elevated inflation for a long time. They want to get that down and make sure it's stable. And they understand that in doing that, there could be pain for many people, not just the market, but also Main Street. And he specifically said that, which I think was telling, because it means that the Fed understands that if they want to make sure that we don't have a problem that's pervasive with inflation, that they may have to push us into a very uncomfortable recession. And that can, we can debate whether or not we're already in a recession, but he really addressed the notion that the market seems to have, that they will be quick to change to a more dovish positioning as soon as they see weakness in the economy. And I don't think that's the case.
Okay, so committed to bringing down inflation, warning of some pain ahead in doing so. But what's that going to look like in terms of rate hikes? As you said, no pause on the horizon, at least thus far. But what do you think this means in terms of rate hikes as you look to the end of the year?
I think you can absolutely expect a 75 basis point rate hike in September. And I believe we have at least 1 to 2 more hikes following that. So there might be a pause in continuing to hike following 2 to 3 more hikes. So going into the first quarter of 2023. But I don't think we should necessarily count on that. I think the Fed is very committed to making sure that inflation is under control, is stable, and they want to see that stability over months, not just 1 or 2 data points. They probably want to see 5 or 6 before they'll be willing to sort of step back and pause.
Yeah, likely appropriate to slow the pace of hikes at some point. So really no indication of when. Want to get your take on the market reaction, though. Obviously seeing quite a bit of a sell-off today. So the market, which has really been able to spin things to have a more dovish tone, not able to spin his comments today dovish.
Yes, like I said, the market seems to have had this notion, and it's sort of priced in that the Fed has been so supportive and reactive to the market, wanting to make market participants feel comfortable that they weren't going to try to do anything that could impact and have a downward turn in overall equity prices. But I think Chairman Powell sort of addressed that and basically said, no, we want to do what's right for the overall economy, and we're not really concerned about what the market's doing. And I think that really made the market less optimistic that we've seen a bottom. And now I think people really understand that it's likely that we're going to see interest rates up towards 4%, and the bond market's not reflecting that, and it needs to adjust. And I think that is actually a headwind to a lot of equities, especially growth equities, which are the main driver of the rally we've seen since June has been some of those growth names. So those have started to come back. And even though we've had really strong economic economic data, sorry. I think what we're seeing is that Powell made it very clear that he's less concerned about having an impact short-term on the economy for the longer positive impact of bringing inflation back towards their 2% target.
So you say the market's questioning whether we've seen the bottom at this point. Do you think we have? And how should investors be positioning themselves in this market, given that the Fed is going to continue to be in inflation fighting mode?
I think the market's shown quite a bit of resilience, and like I said, the economic data has been broadly positive. Yesterday, we had revisions to GDP, making it slightly less negative. We've had very, very positive and strong employment data. The Michigan Consumer Sentiment Survey came out this morning, and it was better than expected. So the consumer has been quite resilient. So I actually am not sure we've seen the bottom, because I think as the Fed continues this hawkish stance and continues to raise rates, we will see more economic pressure, and that will put pressure on consumer spending. And I do think that we'll start to see an increase in unemployment as more and more companies have to cut back to take into consideration the tightening economic conditions. So I do think the market could see some downside, especially in the last quarter of this year. So these are just things that I would keep an eye on, and I would be defensively positioned as a result.
So would you be buying today's dip or waiting for additional weakness to buy some defensive names that you like?
So I'm not big on trying to time the market. When I see weakness in the market and there's a stock that I like that falls below a price point that I'm comfortable with, if it's in a range in which I think it's attractive, I'm going to be a buyer, no matter whether or not I think we're going to see greater downside in the market. So, just things to consider. I'm not the kind of person that will look at the dip and say, yes, I'm going to buy. But if there's a name that looks attractive on this sell-off, something like a Leidos, which is a name I really like right now, that has that defensive posture and that quality bias that I think will do well in a recessionary condition, that would be a name I would look to buy. And even some of the growth names, which I think are hit particularly hard right now, might also be names that I would look at if they started to fall below a certain point.
So you'd buy tech in a rate hiking environment?
Depends on the tech. For example, one of my favorite tech names right now is Marvell. It's not as exposed to the consumer as, say, a NVIDIA, which is also a name I really like, but is trading at quite a bit of a premium. But something like a Marvell, I think I would be a buyer if it fell below a certain point. I'd like to see it be discounted more in line on a valuation basis with the market, and it's not quite there yet, but that is a name that I'm keeping an eye on for the right entry point. So that's a good example of a tech name that I do like, even in a rising rate environment.
All right, might be getting there, down about 7% today for Marvell. Shana Sissel, Banríon Capital Management, thanks so much for being here and sharing your picks with us. Really appreciate it.
Thank you.
Plenty more to come on Trading 3.